Welcome to the Plan to Rise Above podcast powered by P.M.G Wealth Management, a registered investment advisor. We believe that you should strive to get 1% better every day, where every dollar needs a home, and compound interest is the eighth wonder of the world. And with the Plan to Rise Above, you control your own destiny.
What is that going to be?
That's
Enjoy
if you're
the
under
show.
35, these 5 financial moves matter more than picking stock.
These 5 financial moves matter more than picking stocks if you're under 35.
Yep.
Yeah.
Okay.
That's it.
Very cool. And you two are going to do that. That's great. Segment 2, which will be the bulk of it, are going to be signs that you've outgrown your investment firm. Talking about when you get to be a certain level, 2 million plus, 2 million to 10 million, somewhere in there, that range. Just some signs that you might be outgrew that person or that firm. And then we're going to go
In section
segment
1 about you and your family, right? Something that happened?
Yeah, so segment 1 of this episode 9 is going to be about kind of public service announcement for people to double check your TOD beneficiaries at the bank. Well, we'll start right now, I guess. Welcome to the episode. And public service announcement right off the bat is happened to all things myself, but not really me, but it happened to my mom's account at the bank. In a previous episode, I don't know which one, we've talked about TOD registrations. Anybody want to jump in what that is real quick?
Transfer on death.
Transfer on death, which is like a beneficiary form, right?
Yeah, it's like a designation. So like when you die, it automatically get passed to your beneficiary. It doesn't go through probate.
Yep. So it's a form that you would add, and now the banks use it. They call it POD, so payable on death. So that's something you'd have to add to the account. You put it into the, you go in, you sign a form, you give them your kids and your social security numbers for the kids and their birth dates, and they take that form and they file it away. Well, I guess we should think about it. So again, this literally just happened this last week, which means you're watching this about a month and a half later. But my mom goes into the bank, and my mom, if you don't know her, is very, very, very organized. So she went in and says, hey, I want to just double check that my POD is still on file. Who's my beneficiary, right? And obviously, I'm an only child, so it should be me. And they don't have it on file. So the bank had gone through a merger. Her original bank that like from 25 years ago. She's never changed banks, so that's part of this, right? And so I think this probably applies to a lot of people. How many of you have been with a bank that 25 years ago was whatever it was called, went to a different bank, and then that bank got gobbled up into another bank, so now it's been 3 banks, and you would think that that form just kind of stays on the account, and obviously it dropped off. So there it is. So she's like, hey, where's the beneficiary? And she's like, we don't have one.
I thought it had the same name.
Well, yeah, so there's that, right? So that was step 1, no beneficiary. Step 2, they go to fix it, and she sees like something in there with, obviously my name. Well, they have certain things in their programming, I guess in the computer. I don't know where the mistake happened on this. She's actually looking into this at this point. But nonetheless, they come back with my name so Philip, right? And then middle initial. I don't have a middle initial, but somebody else's middle initial. And then the last 4 of the social are not my social. And so who they pulled this person from, it's another client of the bank somewhere in their roster. I don't know if it's a drag and drop. I don't know how it happened. Either way, then the form they give to her to sign for the new beneficiary, which they think is me, is actually not me. So there you go. So then she's like, what the hell? And so now they get it, they fix it, it's all fine and dandy at this point, but they've never completely said like what happened. So again, just public service announcement. If you have a bank that went through a merger, you better go in and check your beneficiary designations, because there's a very good chance they messed it up at this point, I'm guessing. And again, the only reason we discovered this is because it happened essentially kind of to me, or almost happened to me, via my mother. She's highly organized, so she would probably be the first one to find something like this anyways. But nonetheless, like, that's what's going on. So that's the public service announcement, if that makes sense. So
That'd be pretty funny that the other Philip Guerrero just inherits, whatever some amount he just randomly. They're like,
It's
oh,
a
you're
nice
the beneficiary.
check in the mail.
And I don't know. That would be interesting to see how the bank would deal with that at that point in time, right? Like that's definitely a lawsuit, right? Like how would they mess that up? Be like, this isn't you. Be like, well, this is me, and then here's my social, and here's my here's the will and all the rest of it, right? But they're like, well, we have this other person on there. My guess is they'd figure that out, but potentially, yeah.
But they would say like you signed it or your mom signed it, right? And
They
would
would,
just come back and say, hey, like
yeah.
she had a chance to change it and she didn't.
Potentially, yeah.
But you said she caught it off the social, like the last 4.
Yeah, which she didn't give them. That's something that they gave.
Pulled?
They pulled and put in front of her.
So she would kind of just like looked past it, you would say, and kind of just said
99% of people would look past it.
Yeah.
Right.
Guerrero's such a popular name too.
Yeah. I think so, but
Yeah.
But
you also mentioned you don't have a middle name or middle initial.
So that
what
was
what does them stand for?
Oh, PM?
Phil,
Money, Meg.
No, that's,
his wife, Meg, right?
no, that's my
Phil,
god. That's
Megan.
my. I gave myself that middle initial. That's from my godfather. That's Michael. So yeah, there
Oh.
we go. Yeah. So, but that is not officially on my documents. So yes, but all right. So. Segment 1 was basically public service announcement. If you have a POD on file, which you should all have anyways, and your bank went through some mergers over the last 5 to 10 years, and you did this thing a long time ago, go check your form, see, make sure it's still up to date, because they might have messed it up at this point, just with all the mergers and whatnot, because it could go, you might have signed a form that goes back to 2 or 3 banks ago. I think that's probably where this issue lies. So make sure you do a new form with the new company logo on it, I guess, so there's that. All right. So then moving into the second segment, which we've got signs that you've outgrown your investment management firm. Today, we're talking about something that doesn't really get discussed enough, I guess. And it's not because, people are unhappy. They may love their advisor, but basically, the client themselves, so you are evolving. And at some point, you may have outgrown your advisory firm or your management firm. And basically, so let's think about it, like as you've gone up the net worth scale, so to speak, and if you've crossed $1 million, $2 million, $5 million, whatever that number may be, life gets a little bit more complex. And so, for example, you may own a business, you may have concentrated stock, you may have real estate, you have various trusts, multi-state income, different tax exposure, right? And you're worried about, you might be worried about setting up the next generation. And then whatever it may be, your situation has evolved. And it's not just, hey, how is my account doing? So you might have started with somebody who's just going, hey, we imagine this $50,000 portfolio and life was simple. All the reviews were about the investment management piece. And now at this point, you're a totally different person, right? So you still may like them, but you may have potentially outgrown that firm, right? So what are some of those signs that you might have outgrown them? And I don't know who wants to take number one here, right?
One more thing, like there's a lot of good advisors and good firms out there, but a lot of times we get new prospects coming in the door where the bar is very low, like what they're doing or what they're paying for and what they're getting for it is not very much. Mm-hmm. So it never hurts to get a second opinion and just kind of double check things.
Yep. So number 1, right off the bat, is your financial life has become multi-dimensional, but your advice is still one-dimensional. So it kind of goes into what we just said on the lead into this, right? So
yeah, and I would say like if your meetings are just solely what was my performance this year, what's my risk tolerance score, what's the current market update, that would be very one-dimensional, right? That's only one piece of the pie. And when we talk about multi-dimensional, we talk about other things that your advisor should be getting into. It could be estate planning, tax planning, business planning, all of the above. But there's a million different things that your advisor should be touching on that's just not performance related. So that's kind of what we mean by multidimensional.
Yeah, and like Phil mentioned, you might have started off with like a $50,000 account with the advisor, but now you've grown into IRAs, trust accounts, Roth IRAs. You need to have these accounts coordinating with each other. You can't just have all this out on the table. You don't have a plan for how they're invested. They could be invested poorly, and you don't know that. And you just got to make sure you're coordinating all your accounts and making sure that map is drawn out. You can't just have it all on the table.
Yeah, that one's kind of self-explanatory, right? So that one's easy to understand. Like, your life has just become more multi-dimensional because you have more things going on, right? Mm-hmm. And
what would you say, like, if there's an example of something that's outside performance that's a big topic with clients?
Well, again, I think it's, multi-generational, right? If you're talking about how you pass heirs, if you're talking about how do you help, how we're helping parents, right? So aging parents could be one. The tax planning one's a big one. Yeah. Right? And but again, that's another point down here, so we don't want to steal.
But then even business planning too, like if you're trying to sell your business, what's the plan for that? How you how you're going to value your business. Like, what are you doing there? Like, I feel like that's something that we run into as well.
And I guess you can also say, like, yeah, you should have a plan. And if your plan is just investment performance, that's not a plan, right? So it's looking at all the other things. It's looking at, when can you retire, or how long are my assets going to live, right? Those are like the beginning levels of multidimensional. But then there's more to it, right? Just because you have more money.
What's that saying? Without a plan, you're planning to fail.
Pretty much. Yep.
Wow.
Yeah, exactly. So good. And then number 2, and this one, I think we've seen a lot of firms, especially on the boutique side, they've really upped their game here. Taxes are reactive instead of proactive, right? So you're seeing a lot of firms be much more proactive on this. We're talking about doing advanced discussions around multi-year, Roth conversions, intentional tax bracket management, strategic capital gain harvesting, donor advised fund strategy, things like that, right?
Yeah, and you got to remember, taxes are going to be probably your largest expense in your lifetime, right? You're paying it on every dollar you make. You're paying state income taxes. You're paying property taxes. So it's something that you want to make sure you're keeping more money in your pocket versus the government. And there's plenty of legal ways that you can take advantage of, and you want to make sure you're double checking those things. Like, for example, I have a note here about Roth conversions, right? That's something we do with clients. It could be a backdoor Roth IRA or mega backdoor. So those are ways to get your money in a tax-free vehicle. So that way, any future growth you can pull from tax-free, and you're not paying any extra to the government that you don't have to.
Yeah, we have a really good podcast on how the government actually pays you to save and working with taxes and how it actually can benefit you in the long run. And we see a lot of people, like, come tax time, they're waiting for their CPA to tell them what to do. That's kind of like, that's not really that's reactive. Like, you're planning after the fact. You need to be planning before and, like, mapping out those Roth conversions when you retire early, or planning for stuff.
Yeah, and something too, like a Roth conversion, you have to do by year end.
Yeah.
Right. So if you're waiting until February till your CPA is like, oh yeah, you should have done one, it's too late. Right. So you got to be doing these plans early on in the year, and you can kind of forecast, like, all right, if I do a $50,000 conversion, that will keep me in the 12% bracket. Or if I do 100,000, that might push me to 24%. That's a conversation that you want to have with your advisor, and just double check those numbers.
Yeah, and actually, I'd say when we're meeting with prospects and we ask to see their tax return, they're always, like, shocked. They want to see that because their previous advisor probably had never even thought to ask about that.
Yeah. So in terms of this, right, you'd say, right, if your taxes are only being discussed in December or after the CPA is like, hey, drop your stuff off, which would be like February-ish, right? March, at that point, then that's more reactive, right? That's what we're kind of saying. Like right now, we're doing a lot of employee stock diversification type calls. We're looking at, again, like equity compensation in terms of vesting schedules, trying to optimize when we're selling those positions. That's all something that you have to do 3 months ahead of time, 6 months, a year, maybe 2 years ahead of time, right? So that's what we're getting at. So the tax planning piece basically becomes kind of a year-round discussion, not just in December or in February, March.
Why do you think so many firms wait till December to even bring it up? Like, just because they're checking a checklist, or?
That's a good question. I mean, I guess I don't have a good answer for that, other than for years, right? A lot of places and a lot of firms did have that whole we were not allowed to give, you're not supposed to be giving tax advice, right? So, and
it's a new thing.
And it's a little newer. We're still not giving tax advice, but it's with the planning software. There's a muddy middle there to a degree, right? The main thing is, like, which again, further bullet point, we are coordinating with those, those other partners, right? So if we're coordinating with the CPA will take the lead on that. But nonetheless, like, we can kind of work through that year round. Whereas I think for years, a lot of people in the industry just wanted to stay away from it completely,
just because it wasn't really allowed.
Yeah.
Okay.
And sometimes it's other stuff too. Like, I mean, we have a lot of clients that use TurboTax or like a do-it-yourself tax software, and they'll give us our tax return, and we'll spot errors on their tax return, right? So it's not even tax planning; it's making sure, all right, maybe you double counted a 1099, or something's off in your tax return that we can go ahead and double check and make sure we fix it, and we can amend those taxes. So that's another thing we want to take a look at.
Didn't we have a situation like
that?
Yeah,
that's what I was thinking.
I was like, that was recent.
No, I mean, it happens. And like I said, if you're doing it yourself, it's great, you're saving money, but you do want to have a professional to just kind of double check, or someone who's seen plenty of tax returns that can kind of say, hey, maybe you should have done this instead of that, and you can make those changes. And ideally before you submit them, because once you submit them, it gets a lot harder to kind of back things out.
Moving on, then number 3 reason why you possibly have outgrown your advisor or the firm, your portfolio feels like a risk bucket, not a strategy, right? So many larger firms do rely on centralized portfolios, meaning that you might end up in a bucket with a million other folks in that same asset allocation model. And then, depending on, they like to do scoring, which I'm not a real fan on overall, but so they might say, hey, you're 78, you get this sleeve. But realistically, that sleeve falls into, a portfolio of 15 to 25 names that literally, if you're at a big institution, you might have a million people in that same portfolio, right? So it's not really custom to you. So that's why I say your portfolio feels like a risk bucket. And as you've gotten to be successful, and if you've got 2 million plus, we're talking about, your portfolios really should be reflecting your liquidity needs, cash flow, future business transitions, other goals, gifting, if you're doing that to reduce the future estates and all that kind of stuff, right? So we're looking at these bigger issues. It's not just about a risk bucket in your score.
I'd say a lot of firms, like if all your accounts all look the exact same, that could be a red flag too, right? Like if your Roth account, for example, should be more aggressive because you have the potential for tax-free growth. You may have a taxable account that maybe you're paying for your daughter's wedding in a few years, right? You need 50 grand from it short term, right? So that investment should be a lot different than the Roth account, right? So it shouldn't all just be like, oh, your risk profile is 78, you're in this growth portfolio. It should be account by account and by goal. Like what are your goals? When is that time frame? Is it a year? Is it 5 years? Is it 10 years? And then you can make the adjustments from there.
Yeah. Diversification isn't just about picking like 20 stocks. It's about making sure you have the after tax. Like these guys said, you got to have different buckets to be able to pull from. Like in short-term needs, you need like a taxable account, not to get hit with taxes from retirement accounts. You need just buckets to pull from.
And people always ask too, they're like, all right, what do you consider short-term? And every advisor is different in how they approach this. Like for me, I always say like, if it's 2 years or less, really, if it's 1 year, I think it should be 100% in the liquid, safe investment. And then, once you get past 2 years, then you can mix in some bonds, some stocks. But if it's really short term, you want that money in a safe environment. You don't want to have to worry about, like right now we're having the conflict with the war and we might have some short term fluctuation. You don't have to worry about that with, your new boat fund or whatever it might be. It's you got to keep it safe.
And then the last piece I just want to add on that one, which is you do often see somebody may put together a core long-term capital bucket. You may have a short-term bucket, an opportunistic bucket, even then a tax-sensitive bucket, right? But I would argue though, the higher you go up the risk parameter, right, too, you might see private credit bucket and whatnot. Well, to me, that also starts to feel a little centrally managed again. If I can't build one even though I just said like we don't want everything in one portfolio, the counter to that too is still, if I can't build an 82% number with a 75% number, if I want to sell more of the 82 or 85 bucket, well, let's just carve that off and put that over there, and then I can centrally manage that again with a million other people, right? So some of the risk scoring does allow and enable these bigger firms to just kind of carve you up and put you into their stuff, So there's a little of that too that you have to just be mindful of,
I like the bullet point you added too, was that to be opportunistic capital. Like if you're really high net worth, like you might have 50, 100, 250,000 on the side. That way you could really jump on things if things take a turn and you have capital to invest. Like I remember during
it's gonna be more than 250,000, might be.
But but I remember even during COVID, you had like your stock wish list.
Yep.
Like we had the whiteboard going, and it's like, all right, these are stocks that we loved, but maybe valuations got too stretched. And then once we had a real severe decline in the market, we're like, hey, these are ones, if they dip to this level, like we want to jump on it and get into it because maybe we didn't get into it 10 years ago, and now might be the next good opportunity.
Correct. Yep. And then moving on, number 4, the reason that you might have outgrown your advisor or the firm is that the meetings pretty much solely focus on the markets, not any strategy. So this one, again, kind of goes with number 1 a little bit. So yeah, if most conversations include, which again, I do like to talk about these anyways, but we talk about other stuff too. So if your meetings only talk about the Federal Reserve updates and the election and the market outlook, but not if you sell what happens if you sell a business, or not if we're not talking about retirement, or if we're not talking about passing money to the next generation, and we're only talking again about the economy or the market, that's another sign that you might have outgrown that firm, right? So
I would say too, like, focus on what you can control, right? There's always going to be a reason to sell, or a reason the market's up or down, and those reasons are going to change, and some of them will repeat. But really, you want to dial back and say, hey, whatever's in your control, make sure you're giving yourself the best odds for success, because it's never going to be perfect, 100% guarantee. But there's little things you can do throughout the way that increase your chances to be better long term.
Yeah, and anybody can get a GDP update on their phone in like a second. Nobody needs to spend 45 minutes of your hour meeting talking about what the Federal Reserve might do or might not do. And then you're only left with 15 minutes to talk about your real plan. You know, be proactive and talk about the stuff that matters.
Yeah, especially with AI now. I feel like it takes 2 seconds to get, market update and see where things are at.
Although I still like talking about that.
Well,
stuff.
that's more towards the end, and that's like 15 minutes.
No.
It's not 45. We're talking.
I think what we're saying is you still want to talk about the market, but don't make that 100% of the meeting.
Yeah.
Oh, 100%.
Right. So it's
100%.
like, yeah, everyone. I mean, I'd be lying to you if I was like, didn't see why the market was down 1% today or 2% today. Everyone wants to know. Like, you want a reason. Like, that's just, I feel like, human nature. You want to know the cause.
Correct. Yep. Correct. The next reason is you may not have a written plan, or you may not have a capital roadmap going out 2 to 5 years or 5 to 10 years, right? Again, we're talking about higher net worth here, so this does not apply to everybody. But for those that maybe this does not apply to, you're hoping to get there, these are things that keep in the back of your mind, I suppose, right? So you may have a planned liquidity event that's 2 years away. So those are things that, your advisor you guys should be talking about. You may want to be doing some scheduled gifting. Like I said, we already hammered on the Roth conversion, pacing, right? College funding drawdowns. Like, okay, well, my kids are going to school in 4 years to 8 years or 4 years to 7 years. Well, how does that look, and how does the cash flow look going into that? These are all things that you should be talking about along the way, but then you should have in your plan written out. Again, so it's not just talking about investments, it's talking about these other things, right? And then, again, we have just a couple other things in here: future charitable strategy, real estate transitions, risk reduction as you may get older. These are other things that, again, you just want to have kind of documented that you've talked about. So,
and I would say even more short term, I know we're talking 5 to 10 years. Every client that we have come in the door, if they're a $10 million client or $100,000 client, I mean, we give them the next 90 days what they need to do, the next 6 months, and then the 1 year plus, right? So every initial plan, like, we're giving you more of a short-term roadmap. Like, this is exactly what you need to do. So 6 months from now, when we meet, we say, hey, did we hit this point? Did we hit that point? And we'll make sure to hold you accountable and making sure you're hitting those goals.
What's the most common roadblock you see when a client comes to us without like one of those 5 to 10 year plans or roadmaps? Like, is it? Well,
I would say what pops in my head right now, the most common roadblock is unrealistic expectations of where they're heading.
Wow.
Which is a complete smack in the face to a lot of people.
Yeah.
And I hate to say it, but in real simple terms, they could be living in La La Land.
Yeah.
Right.
And those are some of the conversations we have. Like, we'll have the hard conversations. Like, no, you're not going to be able to spend $80,000 a year come retirement. We're having those conversations now so that it's not stressful come retirement. We already know what's going to happen. We've been doing these projections. We've run the scenarios, and it's like we have the roadmap planned out. So we're pretty much acting before the event and letting them know what will happen.
Yeah, and your advisor should challenge you. It shouldn't just be like a yes man. Like, it shouldn't just agree with everything you say and say, hey, yeah, you're fine, you're fine, you're fine. They should say, hey, put your foot on the brakes. Like, we need to adapt and we need to change some things. Otherwise, this is what could happen. And not in a mean way. We want to look out and say, hey, if we continue on this path, this is where we'll be. If we take this route instead, we'll be much better off. And
yeah, so, you don't want to come knocking on the door at 72 saying it's moving day.
Yes, 72 or 82 or whatever, right? We don't want to be doing that.
Yeah.
That's all right. Moving on, number 6, the reason why you may have outgrown your advisor, and this is probably a little bit of Again, we're not trying to put anybody down. This is not the goal of this, but this one is specifically directed at the banks, right? Which is your banking and your investment strategy feel blended. So this is specifically talking about almost like too much cross-selling going on. So you may be encouraged to have, security-based lending. You may be saying, hey, you need to put all your deposit accounts here under one roof. We're talking about, if you hear this term, relationship pricing, we can give you some discounts if we do some other things, right? We're talking about mortgage alignment. I didn't even put it as a bullet point, but one that pops in my head right now is give you a discount on a credit card. These are, to me, are just kind of like, there's a relationship with that firm. Are you now just becoming just a number, or are they truly looking at you and what's in your best interest and all of those kind of things? And is the portfolio that they're building for you really geared towards your life, or is it just another, do you basically have deep enough pockets that you're just somebody we can cross sell and put you into this new product, put you in this new product, put you in this new product? That's kind of what I'm getting at, I guess. So that one's a little touchier. I'm not trying to step on any toes, really, but you do see that occasionally, right? So,
and I see it even with my personal bank. Every time you make a deposit, it's like, hey, you could open up this account or you could buy a CD. And not that some of those ideas are good, right? But I would just double check it. Like if their CD rate's 3, you could probably get 3.5 somewhere else. And same with mortgages. I know a lot of people keep a certain deposit with the bank for a better mortgage rate, but those rates are still not the best. So I would just say double check, check with your advisor, your mortgage broker, people who are familiar with the current rates and what is competitive, and just make sure you're getting the best bang for your buck.
Back to the public service announcement before this segment, check your PODs at the bank that they didn't get rid of it. So yeah.
Yeah, there's a massive difference between a bank offering you a loan or a mortgage that, because it's a good tool for you, then it's a bank offering a loan because it keeps you sticky to them. Like they want your business, they want you there, so they'll offer you stuff and they'll keep offering you stuff.
Just might be a reason that you've outgrown them. That's all we're saying. Now, this one we do like. The next one, your estate plan does exist, but it's not really actively integrated, right? So we're talking about, again, at a higher tier, you may have a trust done already, but nothing is going into, we're not doing trust funding reviews. Nobody's doing beneficiary audits. When was the last time your advisor ever put back in front of you, like, hey, these are your beneficiaries, just double checking. We're looking at titling alignment and liquidity planning for heirs. Now we're talking about specifically what money is going to be available for your kids upon your passing, right? What can they get at in a short window of time? Again, back to the gifting cadence. Should we be taking money out of your estate and giving it to your beneficiaries while you're living? These are conversations that should be talking about. And again, even having value conversations with the kids, trying to teach them who you were in your savings life and in your lifetime. Not just, they know you as their parents, obviously, but like, what were your values, right? Trying to have those conversations a little bit. So there's a lot of little things like that would be much more of a comprehensive strategy that, again, your advisor should be in on those meetings and trying to do it. Like I said, we do a lot of stuff here that's multi-generational. We're working with kids. We're now starting to work with some grandkids. These are all things that are also documented, and it's not just back to that earlier bullet point of what's your account done this quarter.
Yeah, and talk, just making sure our clients are having the conversations with the older generation and the younger generation. You want to make sure everyone sees eye to eye. I do know recently we had the blog post about the "in case I'm not here" document. So that one, we got a lot of traction from clients like wanting to see that. And that was basically not your beneficiary designations, but, all your different accounts, who your professional contacts are, what are their different logins for these different bills, just all in one document. So you could say, hey, if I pass away, this is everything. This is where my LPL accounts are. This is who cuts the grass, who feeds the dogs, like every little thing on it. Some stuff that you might not find normally, and that just makes sure you cover all your bases.
I'm going to skip the next one. I think we are actually kind of morphed this next bullet point into these other ones, so we're going to leave that one be. The second to the last one here is your advice is not coordinated with your other professionals, right? So we're actually talking about, is your advisor recommending to bring in your attorney? Are they recommending to bring in a CPA? Are they using any tax plan software? Are they using any estate software? Right. So, these are all things that are now available at pretty much a lot of firms, and that this one's kind of an easy one to understand. I think that you might have outgrown your your firm if they're not looking to bring in your accountant. So.
And your advisor should have a team of people behind them that he could refer you to as well. So like I would just check with them. They should have a state person they've worked with, a CPA, insurance person. They should have those resources in place already. And then one thing I wanted to add too is always double check not only the other professionals' background, but your advisors. So like for your financial advisor, there's a website called Broker Check, and you can see the history, see if they have any red flags in their history. Because like for us, like if one of us ever got bankrupt, right, we would have to report that. Or if we had a short sale in our home, and people never check that. They still work with advisors who struggle managing their own finances, let alone someone else's. So just make sure you double check those public disclosures.
Yeah, what's one of the biggest wins when we finally got like the CPA and the client, us, all coordinated? What's one of the biggest wins you've seen?
What do you mean by that? I guess, one, it just makes people feel more comfortable. It's nice to know that all the bases are covered. I would say that's probably the biggest win, right?
Things go smoother, right?
Things go smoother. You can crack the joke of like even more recently, right? We're helping with the state documents even through a portal that we have now. But whether we refer that to an attorney or we do it, you crack the joke at the end, like, okay, well now you can go die in peace, right? And it's and it's like obviously you don't want anybody to go anywhere, but the reality is it's nice to know that check the box, that's off the table, and you don't have to worry about it. And so I would say the coordination with other professionals is exactly that. It's like, okay, well, I don't have to worry about that because so-and-so has that covered, and I can worry about this. And then collectively, the client is like, they can go and do what they do best, and their team can go do what they do best. And it's just a much better process for everybody. And then at that point, whatever the area is, like the client doesn't really have to worry as much about the future because it's all pretty much planned for behind the scenes. So. Yeah. I think that's the main point, right?
Yeah.
I think, like you said, the client's got to do what they like to do. And, we're sending the 1099 to their person for them, right? We keep them organized and they kind of are more hands off. And I feel like they prefer that.
And then just the last thing, and this is not really the point, but if you never evaluate what independent advice looks like, again, a lot of people have stayed very loyal for many, many years, maybe even decades. You might have followed your advisor through a transition every 7 to 8 years. They leave firms. And they move to a different firm. I don't know why they might do that, but that's for you to figure that out. Maybe it's been a while since you've compared advisory structures or what else is out there. And, so again, like the fact that you've outgrown does not imply that you're unhappy because you could be perfectly happy with the relationship and the people. It just may not be the best fit where you are now or where you're going to be for the next 10 years. So either way, so that's all we're bringing it up. And again, obviously we got clients too. We don't want our clients going anywhere,
No.
But this is a different one that I would say at a certain level there are things that we can look at that people should be focusing on now and where the industry is, and it is very, very big picture today, and there's still a lot of firms that are just not. So that's where we are.
And I wanted to add one more thing. You mentioned working with an independent advisor. I think what you mean by that is they're not attached to a larger firm. And one way to see that right away, like if you look at your statement and it's all one fund company, that might be a red flag, right? So if it's an independent firm, right, they can use any fund company. They could use good ones that make sense for your situation. But if it all says I don't want to name the firm name, but if it says all XYZ fund from this family, you might want to double check that and and review what's right for you.
Correct. Yeah. And just a little bit of a different segment, which was, again, some reasons why you might have outgrown your firm. Hopefully you found that of interest and give you some food for thought. And again, that is specifically talking about people who've gotten a little bit bigger, obviously that have a little bit more going on. Nonetheless, anybody looking for a second opinion, or if you don't have a plan, remember, we try to, we strive to plan to rise above. So keep us in mind, and we're happy to help. But there's plenty of boutique firms out there that are excellent, and I'm sure there's one in your area that you can talk to anyway. So that's great. And I'm going to step away for this last segment because it is geared towards a little bit of a younger crowd, and I also want to get these two a little bit more TV time, so to speak. So we're going to test this out a little bit, see how it goes.
Now we're going to move into, if you're under 35, these 5 financial moves matter more than picking stocks. So what we mean by that, we're not trying to chase like the next NVIDIA or Apple or crypto even. We're trying to chase, or we're trying to make you into a better saver, investor. We're trying to build you into like a more aggressive saver. We don't need you researching stock at 10 in the morning on a Saturday, trying to find that next NVIDIA. We need to start building like savings.
Yeah, good habits and stuff that'll help you long term. I mean, I feel like everyone goes through a stage, right, where you want to learn everything you know about stocks, but at the end of the day, you know, if you have a smaller account, right, a 10% return on $10,000 is less than a 2% return on 100,000, right? So your goal should be, we've talked about this before, but it's getting to that first 100,000, that first 250,000. And you know, in this segment we're going to talk about some of the ways we can do that.
And George and I spend most of our day in like the engine room of P.M.G, behind the scenes, running the data, double checking the math. And what we see is it doesn't matter if you pick the next NVIDIA stock or Amazon or Apple. You got to save. You just got to start doing the right thing and maybe listening to a P.M.G podcast.
Exactly. But we talk about, move number 1, increase your savings rate before you increase your risk. You know, the biggest way you could help yourself early on is bumping up that savings rate. Like I know, you know, Ryan did it. I did it when I was young. Like we were maxing out our 401ks the first year out of college, right? Because we were young. We had very little expenses and we had opportunity. And we could see from our planning software at work, like, hey, if we max them out right now and we're 23, well, we were 23 at the time. You know, this is what it's going to look like when we're 50. And I know for me, like I see the dollars, I'm like, oh, you know, this one change is $1 million move to the green. And I'm like, that's easy enough. Like it's a no brainer, I think. So yeah, like I said, time is your biggest asset early on. So make sure you're increasing that savings rate, you know, to make sure long term you'll have more money.
Yeah, the math is boring, but it's undefeated. In your early 20s and 30s, your wealth is driven by how much you dig into that hole, how much you save in your account. It's like George said, a $5,000 investment account with a 15% return, you made $750. You invest $15,000 and get this boring 7%, you made $1,050. I'd rather save more money and get a lower safe rate than be chasing that higher 15% rate.
Yeah, and it's easier too because it gives you more flexibility in the future. Like even for now, what I run into is like, you know, we just had our first kid, right? So I know, you know, people are like, oh, kids are very expensive. Like you're not going to have any money. Well, I know if I need to, I could dial back some of my savings now because I'm used to never seeing that money, right? I'm used to it going away in the accounts. So that gives me, it gives me peace of mind because it's like, hey, you know, if I need an extra $1,000 a month, all right, hey, I can pull back here to get that money and my income doesn't change, right? It's just I'm saving a little bit less. And it's hard to go the opposite way. It's hard to add that savings once all those, you know, the home, the kids, you know, cars start adding in. Like you're not going to increase it later on.
And you're also already ahead of yourself with all those cars, kids, houses. Like you already have like a little bit of debt building and you don't have any savings going on. So you're kind of putting yourself in a deeper hole.
No, exactly. So, there's a lot of things, but yeah, move number 1, increase your savings rate. If there's one thing, if you're under 35, like I would say definitely hammer on that early on.
Yeah.
And then you want to take us into number 2?
Yeah. Move number 2, protecting your greatest asset, which is your income. So let's say you're 30, you're making $150,000 a year, $100,000. Your future earnings are worth millions. You like, let's say you bought a $5 million building. You'd insure that. Most people won't spend a dime on the disability or proper life insurance. Like these are the times that you need to be protecting your income.
Yeah. Yeah. We always talk about having term insurance for clients, right? If you have a mortgage that needs to be paid and if you're gone, like that mortgage needs to get paid. So you might have a term life insurance or disability. Another thing I want to touch on too is your income has no upside, right? So always, you know, really push yourself to say, hey, I want to advance in my career or I want to negotiate my salary and hopefully increase that earning power. Because we've seen it too with, I think we had a couple of new people come in recently and they worked somewhere for almost 30 years, which is great. But a lot of times these days, companies don't reward you for loyalty, right? So like their salary, it was okay, but it should have been a lot higher for their years experience, right? So just, it's not saying that all companies are bad, but just make sure you know your worth and you push ways to get your income up. Because you can only cut your expenses so much. But like I said, income has no upside.
Yeah, and you can't can't make an income when you're hurt or on
Yeah.
well, if you're on disability, you can get an income, but
No, but yeah, you need disability
Yeah.
insurance.
you need to check all those boxes.
No, especially too, like a lot of households, one spouse is making a lot more than the other, and if that one spouse something happened, or maybe not even a disability or a recession, right?
Yeah.
They need to have that emergency fund in place to keep things running smoothly, and they're not, having to sell their home or really uplift their whole life just because one bad thing happened.
Yeah, it's like we don't want to come knocking on your door at 71 telling you it's moving day. It's probably just as worse doing it to a 30-year-old that overstepped their boundaries and
That'd be
didn't
terrible.
plan,
Could you
yeah.
imagine like saying, "Hey, Sophia, we gotta move school districts. We're
Yeah.
going, moving to Wisconsin. See you guys. Gotta sell your home." That's not what you want. So that takes us
to move 3. Right?
to move
Yeah.
number 3. Automate investing so emotion doesn't interfere. And that's a big thing too. Like if you have to go in and say, "Hey, I'm sending 500 to my account each month manually," you're going to forget, or it's going to get put to the side, or it's like, "Oh, I'll do it next month." And then next month, it's like, "Oh, I'll do it next month." You want to automate it. So there's no emotion. You're not worried about, "Hey, Trump said this, the market's down, or Biden did this, blah, blah, blah." You want to make sure there's no emotion in it. You're buying at a consistent pace no matter what has happened.
Yeah, I just think it's easier to see it taken out of your paycheck right away than it hit your bank account. And then you're like, "Ooh, I got all this money. I kind of want that new thing." But if you already had it taken out of your account, it's gone. It's in your retirement accounts. You're not touching it till you're 59 and a half. So it's just easier to see it gone right away. And then you're building that habit too. Like if it's automated, it's going to hit on the first of the month each time, and you can plan accordingly to it. It might make you spend a little less at the bar or at
Teddy's.
Yeah, Teddy's.
Or the
Rest in
slots.
peace. Yeah, Teddy's closed.
Remind you're back at the slots.
Yeah.
No, I mean that's a good point too, because like if it hits my bank account, I'm like, "Hey, I might buy a new drone.
Yeah.
I might buy a new
Yeah.
car," like something crazy like that. So it's like just
Might
keeping
trade
it
in
separate.
the orange car and
I
get
know.
a nice new
might turn
Tesla.
I see that happens. I get paid. I'm like, "Hey, the used cars aren't looking too bad anymore." But yeah, so that's a big thing. Just automate it, take the hassle out of it, make sure it's getting done no matter what's going on. But then, so let's say move 4. We kind of did touch on this already, but invest in your career capital, not just market capital. So what we talked about before is, hey, advance in your career, making sure, like for us, the CFP, right?
Yeah.
We make sure we're learning, we're always getting better. We're getting a designation that makes us hopefully more qualified and more educated in our field. And depending on your career, if you're an accountant, it might be a CPA. So whatever you're working on, just find ways to invest in yourself, right? Not just stocks, bonds. Like you want to buy back into yourself and bet on yourself essentially.
Yeah, and there's probably a certification for every job title. And probably the easiest way to move up in those jobs is to get certifications. You look at your boss and they probably have 5 certifications and you only have 1, and you're asking yourself, "Why am I not getting paid?" It's because you're not putting yourself forward and making yourself take all these extra classes, building your education, and you just got to invest in yourself. Be 1% better every day.
Yeah. And I mean, Phil's not here right now, but that's exactly what he did when he launched P.M.G, right? So he's working for a larger firm and he bet on himself. He invested in himself to grow the company himself, right? So long term, it's paid off very well. But short term, it's definitely risky, right? You got to, you got kids at home, you got bills that need to be paid. And
mortgage,
yeah. So it's high risk, high reward, right?
Yeah, but certifications are probably the
Yeah,
lower risk,
that's a lower, but
still
yeah.
good reward.
Yeah, but and when you're young, like we're talking to people under 35, that's the time to make those risks. When you're 40, 50, it gets way harder. There's so many obligations you're tied to, and it's you got aging parents, you got aging kids, and then in different paths of the life. So like you have that 10-year period, you got a lot of flexibility, and don't take it for granted.
Yeah, I'd say if you're still under 35, get as many certifications in your career or in your job title that can help your job title grow.
That's the time to take a risk. Like if you're just, if you're in a job that has really no upside and you see the writing on the wall, like, hey, keep looking. Now's the time to be making moves. Once you settle down, it's going to make it a lot harder.
Yeah, because you have all this time available. Like right now, if you just have the baby Sophia around and you're studying for the CFP, that'd probably be huge headaches.
That'd be, because it'd be like, oh, I'm waking up at 2 a.m. and then it's like I gotta wake up at 5 to study or whatever.
You're drinking a lot more coffee.
I know, I'd be chugging the coffee, the caffeine. So get that out of the way, making sure you're taking care of that.
Yeah.
So that takes us to move number 5. Avoid concentrated bets that could set you back 10 years. Do you want to touch on this one?
Yeah, it could be being the all-in on your company's stock or having that 80% crypto allocation that could blow up tomorrow, and you just don't know. And when you're young, you feel like you have more time to recover from zero, but you're also missing out on those compounding years that in your 20s you can't just buy back, or, well, you could always save more, but then you're just shooting yourself in the foot because you already saved that money once, and why rebuild?
Yeah, and I see it too. I feel like, I even did it myself. I remember the first stock I bought, and I was like, oh, it's doing great. And it did great the first 6 months, and then it collapsed. And I just held it and held it and held it. And luckily that was when I was young and I didn't have a ton of money to be invested. But I feel like everyone kind of gets married to their first winner, right?
Yeah.
It might be individual stock. It might be crypto. Like, who knows what it's going to be. And it's, I guess in a way it's good when you're young, right? Because you might only have 5,000-10,000 invest, and that's not going to break you long term. But it's learning those lessons early on. So as you get into your late 20s and you're making bigger money, you're not making the same mistake. As Ryan said, you're not going all in on one stock or all in on crypto. You kind of learn those lessons when you're younger, got it out of your system, and now you can say, hey, there's better ways to do this. There's better ways to set myself up.
Yeah.
And we've seen it too. Like, growing up, like I saw like my parents go through the recession, right? I saw my mom get laid off, and like that kind of sticks with you, right? You see, like right now we're in a great period, a great bull market. Everyone's making money. Everyone's employed for the most part. But there's going to be periods where it's harder and changes need to be made. So we want to protect ourselves. We don't want to say, hey, we're 100% in financial stocks, right? Then 08 hits and financials take a hit. So we just want to avoid that if we can. So I would say to wrap it up, the real order operations for if you're under 35 is, build your foundation. The bottom of it is going to be stability. As Ryan talked about, is having an emergency fund, having your insurance set up, getting rid of that toxic high interest debt. After that, it's going to be automate. Make sure your money's going to this account each month and you're maximizing those tax beneficial accounts. After that, we want to increase your income, right? Find ways to advance in your career. There's different ways you can do that. And then as your income grows, don't just spend every raise, right? Put some aside and, raise your savings rate as your income grows. And then as that pyramid builds, your net worth is going to go up and up and up, and there'll be even more opportunities for financial planning.
Yeah, if you're under 35, your home run isn't finding the next Tesla. It's building a system that can't fail. If you're solving for the perfect stock before you automated savings and protected your income, you're building a house on like sand pretty much. It's going to collapse eventually.
Yeah. And to close it out, I would say ask yourself, is your savings rate at least 15%? Is your income protected? Is your investments automated? Like if you can say yes to all those, you're doing a great job.
Yeah.
If not, take those as some action steps going forward to make those changes.
So thanks for tuning in to episode 9 of Plan to Rise Above. Don't forget to comment, like, subscribe. We'd like to hear from more of you guys. Like, comment what you think we should talk about next, or maybe you didn't agree with something we said and love to have a conversation on it.
So we appreciate the engagement. Those of you that follow us on YouTube, LinkedIn, continue to like, comment. I was at a wedding the other weekend and had a guy come up to me. He's like, hey, I saw you on the podcast. And that ended up to lead into, we had our initial meeting together. So we're starting to take action and make changes. So all it takes is one phone call, and we're ready to help you.
Yeah. Plan to Rise Above.